All right, in this short recording, I'm going to give you some examples of some of the things you might have come up with when you're making your comparisons between Coca-Cola and Pepsi. These aren't the right answers. There are no right answers. It's just some of the things that you can pick out. Now, I'm going to limit my analysis to two or three things, and you might have picked out other stuff, and that's fine. So this is just an example of some of the things that you might have noticed. All right, so we start with the consolidated, the common size balance sheet. One of the first things that jumped out at me was Coca-Cola tends to have slightly more cash than Pepsi. All right, so Pepsi's cash has gone from 6, 9, 12, 12 to 17. It's been increasing. Coca-Cola's has increased a little bit, but it's been higher all along. All right, and it's always been higher. So they tend to hold more cash, fewer receivables. Okay, so the total between the two companies, Coca-Cola current assets about a third, and Pepsi's have gone up from about 25% to a third. So still similar, but that's a slight difference. The net property, plant, and equipment tends to be higher for Pepsi than for Coca-Cola. Note the high levels of goodwill for both companies. That goodwill shows up when you're buying other companies. It's the excess of what you pay for the company over its book value of its equity. So those are indicative of them buying stuff. Other non-current assets, I have no idea what that is, but note that between the goodwill and the non-current assets, that's about 50%. And so if I was actually going to do a lot of due diligence looking up Coke and Pepsi, I'd want to know why that number would, what type of assets are included in the non-current assets to have a better idea of the valuation of the company. All right, so let's move down into the liabilities and equity side. One thing that we see here, Pepsi's accounts payable tend to be higher, and that's probably a function of the type of stuff that all the Pepsi companies purchase. So we do know there's differences. This is something that leaped out at me. Short-term debt for Coca-Cola running about 20 to 25%. That's unusual. You can see Pepsi's is less than 10%. When you see a high amount of short-term debt like this, it's indicative of a company that's borrowing in the short-term market. That's not good or bad, it's just unusual. Interest rates are lower on short-term debt than long-term debt. That's the good news. However, in this day and age, long-term debt rates are so low anyway, there's not a lot of spread between them. The downside of borrowing in the short-term debt market is that when you go to roll over the debt or reborrow it, you can actually run into financing troubles. So Coca-Cola, of course, it's a big, strong, well-known company. They can get away with that type of thing, but that's something that I would consider unusual. Usually when you have spikes in interest rates, the interest rates spike in short-term debt before they spike in long-term debt. So between the two, you see 32% long-term debt, 18% short-term debt. That's about 50%, okay, of interest-bearing debt, and a large part of their interest-bearing debt is short-term debt, and the amount of debt has been increasing. All right. In contrast, we look at over Pepsi's debt has been increasing as well, but it's mostly increasing long-term debt. So the total liabilities for Pepsi have gone from about 3/4 up to 80-something%. That's a lot of financial leverage. Now we'll talk more about financial leverage going forward, but when you get into Chapter 4 and start reading up on the good and bad aspects of financial leverage, that's a lot. All right, if we go down here and look in the equities portion, common stock and paid-in capital tends to be higher over here for Coca-Cola. The retained earnings, that's real similar. The treasury stock, both of these companies have been buying back their own shares of stock. And the other equity, that can be a lot of things. With big international companies, it gets complicated, but we just note that by all measures, Coca-Cola has more equity and less debt than Pepsi-Cola. Okay, so that's the big thing you ought to pick out there. If we go down to the income statement, it's very similar for both companies, but there's some major differences. The gross profit margin is much higher for Coca-Cola. All right, much higher for companies this size. That's a big difference. All right, it's about 6 percentage points. You'll note that there was a big difference in the sales, general, and admin and depreciation expenses for Coca-Cola. I got these numbers from Morningstar, and I think they had a coding error, because if you add the two numbers together, it's about 39 or 40. Add these two together, it's 41. I just think they coded something funny that should have been a selling, general, and admin expense, and just coded it differently. But you do see very similar SG&A, a little under 40% for both Coke and Pepsi. But Coke has already earned an extra 6 points on its bottom line just by having lower cost of revenue. And so when we get to the net income line, Coca-Cola more profitable than Pepsi, and the profitability is eroded a little in the last couple of years. That could be related to acquisitions.